Talk to me about how long you've been in real estate and how would you explain the type of market that we're having right now?
Well, I have been in real estate, all forms and aspects, because to say real estate in a general term is doing it a disservice. But basically speaking, for well over 4 decades.
Wow. Okay. 4 decades. That's a long time.
Yes, it's a very
Okay.
long time. And one of the things I always emphasize to people in describing not only my experience, but anyone else's experience, longevity is not necessarily the key to accurate assessment of what you're doing, to proficiency or anything like that. So I
Okay.
know people that have been doing it for 50 years and they're still relatively incompetent, because it goes back to what the great coach, Green Bay Packer coach Vince Lombardi once said when asked, someone said to him, "So I guess practice makes perfect." And he said, on the contrary, he said, "Perfect practice makes perfect."
Well, that makes sense. All right.
So if you've been in the business a long time and repeating your mistakes or your inaccuracies about product and whatever, then obviously you're not going to be the most proficient.
So, what is the one thing that you feel that has kept you in the business for that many years?
My intellect, my ability to connect with people, and the fact that I never did anything that I ever looked back on and was ashamed of. I always considered the other person first and then my profit second. I always did what was right for my borrowers. I always, in real estate, I always did what was right for my sellers and my buyers, whether it benefited me or not. There were many times it came down to the wire that somebody was not going to be able to get a house, and I gave up my end to make certain that they had the cash to close and do their end. And now they are referring their grandchildren to me for mortgages. So that's always been my mantra. First of all, you need to know what you're doing, and that's by definition my intellectual ability. I understand how to read the marketplace. I understand when interest rates are going to go up, when they're going to go down to a certain degree. I mean, I'm not a cockeyed wonder. I predicted this 2008 debacle and crash. I was not the only one, but I saw the evolution of this lending and knew it could not be sustained. And it would just be a matter of time until the whole thing came crashing down. Again, I didn't know when, or I would have sold stocks short or things like that. I mean, I'm not a cockeyed wonder, but so those are the answers to that question.
Well, did you also predict that it would get to the level that it did?
Yes, absolutely.
Really? Hmm. Okay. All right. I'll take your word for it. All right. Tell me the short version of how you even got into real estate in the first place. Not the long story, just the short version of it.
Well, when you're asking for short stories, you're talking to the wrong person. And I think you've come to realize that over the years. But, and when I train salespeople, I share with them brevity is an important characteristic of what you're doing. And yet I have yet to embrace it personally. But what I can tell you is the way I got involved with real estate is when I came down here, I had a multitude of different jobs to make money, but I never had a job that I considered would be my career, but I had the ability to earn money. And then I met an individual who was retired and was working with a friend of his, a younger guy who was just opened up a real estate office. And he saw the opportunity to open his own office, and he approached me, and we never had any paperwork. He trusted my integrity, and the rest is history. He opened.
All right. Let's see how you handle this one. So what's up with the beard and the mustache there?
Well, that's a very interesting story. This mustache originated back in 1968 as a point of defiance. I was in the Army. me. And as I came out of basic training, they said, okay, now no facial hair, no one can grow anything. Okay. Then they said, well, you know, there were some people with mustaches, some officers, so okay, you can grow a mustache, but you can't grow it past the end of your lip. So because I could not do that, I had to figure out how to do that. So what I figured out was for inspections, I could tuck the ends into my mouth. So, and I did that, and I passed every single inspection. But when I was walking on base, some of the officers looked at me and wondering, how the heck did I get away with that mustache? And over the years, it just had a mind of its own. It just grew, extended, and there was a direct correlation between everything that was growing above my eyebrows or not, and everything growing below my nostrils. Hence, the end result.
That's a good
And I
one.
just made that up, by the way, but it's a true story. And one of the things that adds to my success is my ability to think on my feet.
So how would you compare this market to, let's say, the crash of 2008? Because a lot of people think that, you know, we're in for a crash. So what are your thoughts?
Well, to begin with, there's absolutely, positively no comparison. It's comparing apples and oranges. They are both fruits, the last I checked, but they're entirely different kinds of fruit products. So the reason I say that is because in 2008, the real estate debacle was caused by many factors, the most of which were the lending aspects of the marketplace. So because all the lending requirements, they lowered the bar so low that people who should never have owned property were able to get mortgage financing to acquire property. And there was a period that you could not make a mistake. If you bought a house for 200,000, you could sell it in 6 months for 225 or 250. So you couldn't make a mistake. But what was happening is those individuals were perpetuating the mortgage debacle, meaning that they were getting higher mortgage financing, increasing their monthly costs, and they never intended to live in the property. They intended to flip the property. But when everything started to go bad, when I say everything, I mean a lot of the loans started to become non-performing. And remember, this is the whole debacle with in the mortgage marketplace with verifications of income. When I started, and remember, I do mortgages as well. When I started, the only place I could do mortgage financing for somebody who had irregular statements or an unusual job. So as I was saying, so those were the only places I could do a non-conforming, non-traditional type of loan. And then as things moved along, companies came out with, they called it subprime, but what it actually was non-traditional and non-conventional. And it started with, well, we could do a no income verification, no asset verification, or a NINA, no income, no asset verification. But on the loan application itself, at the bottom where the borrower was, after all the information above, the borrower read this paragraph that states any misinformation, misleading, whatever, is a federal crime. It's a felony, not a misdemeanor, that sort of thing, and it violates federal statutes. And borrowers would sign that. They would never read that paragraph, and no loan officer would read it for them. So what people didn't understand, they were committing fraud. And when it says no income verification, no asset verification, it doesn't mean that you can lie. It just means that whatever you tell us, we're not going to verify.
Okay.
So big difference there. Just 1 second. Let me just do something here. So people didn't realize that. And what they were doing was committing fraud. But it didn't matter because they were out of the loan sooner than anyone could detect any problems or what have you. And the biggest judge of the marketplace was what we refer to as first payment default. So there were a lot of borrowers that could never make the payments. They were looking to flip, they were looking to do whatever, and then the market got a little soft. They couldn't flip, they didn't make the payment, and everything started to hit the fan.
Wow.
But
So
we
who would you blame for this? Would you blame the greedy homeowners? Would you blame the mortgage individual, or who? Who take the blame?
Well, the first thing, a comment on the question. I think people should ask open-ended questions and not answer the questions themselves and give multiple choice like you just did. But that's just a sales lesson. That's off the charts. Let's get back to the mortgage issue. In my professional opinion, who is to blame is the secondary market because they got greedy, meaning that if I originate a loan as a loan officer, any loan officer, even loan officers in lending institutions, traditional lending in Bank of America, Wells Fargo, it doesn't matter. When a loan is originated, they sell that loan into the secondary market, meaning like take Bank of America, maybe they did 20 different loans and maybe it was on 20 different types of properties. It could be on a duplex, it could be on a single family, it could be on a townhouse, a condo, it doesn't matter. They would take these loans individually and bundle them and then sell them in a secondary market where they made a security secondary.
Well, what do you mean by bundle?
They would bundle the loans. In other words, Bank of America would take those 20 loans and sell them as one tranche
Okay.
in the secondary market, sell it to Fannie Mae, Freddie Mac, or what have you. But wait a second. Fannie Mae and Freddie Mac have very strict requirements and guidelines. So they wouldn't accept these subprime loans. So these lenders, quote unquote, they really weren't lenders. They were using warehouse lines of credit and things like that. But these lenders would go out and create their own guidelines. And one lender would accept 75% loan to value. Another lender would require 80%, would require rather 70% loan to value. So everyone had their own guidelines, their own standards. It used to be when we used to take a subprime loan, when I would originate a subprime loan, I would take that loan and shop the marketplace, see who's buying 75% LTVs, who's buying 70% LTVs. And interestingly, loan officers got hammered if they focused on the rate. You need to focus on the ability to close the loan. People didn't really care much if there was a difference in the interest rate. They cared whether or not they could get the financing to buy what they're looking to buy. And what happened is that those no income, no verification loans, no income verification, no asset verification, because all those loans was now, there was a secondary market that was created, and all those loans now were changing. So if it was a requirement of we're only going to lend you 70%, now they said, nah, we'll lend you 80%. Why? Because there was a flurry of loans being originated and they had to sell them. So they said, okay, we'll do 75%. Then it was 80%. Then it went as high as a borrower could get cash at the closing. So they could borrow 105%.
Wow.
So
Wow.
it's inevitable. What happened? It's absolutely inevitable. And what happened was the secondary market now was awash with bad loans.
Okay. Okay. All right. Yeah. Well, that's interesting. I'm thinking that there had to be some type of regulation, so someone has to be watching someone just to make sure those things don't happen.
Back then, as a result of the crash or the debacle, whatever you want to refer to it, from 2008 going into 2009, they created the financial regulation boards and all sorts of things that would now go into place as kind of checks and balances. And people were starting to be called on that very paragraph I shared with you when they lied about their income and or their assets. And it used to be that you didn't, sometimes you did not even have to state who you were working for or what you, if you were self-employed. Now, so just fill out an application, put your name, social security number, we'll pull up your credit. Oh, and by the way, now when we pull up someone's credit, they have to be within a certain credit range, credit score range, like 680 and above or something like that. Back then, we were doing 520s and 540 credit
Okay.
scores.
All
So
right. Well, here's what's bugging me. You hear people say that, you know, they have foreclosure rates going to go up because the moratorium is going to end, and you get, you know, real estate prices going up.
you mean the
So something's going to
foreclosure
give.
moratorium?
What was that?
You're referring to the foreclosure moratorium?
Correct, correct. So something's going to give if people are not paying their mortgages, their rent and stuff like that. You know, so you don't believe that there will be a crash just based on that?
No, not at all. There will be a void. First, let's identify the fact that the pendulum never rests in the middle. It either swings to the left or to the right. Okay,
Okay.
so in thinking about the mortgage marketplace and in thinking about the real estate marketplace, not only was there mortgage foreclosure, they stopped foreclosures, they stopped evictions and things like that. Not only that, a lot of the lenders, as a result of COVID, created forbearance, which meant that you don't have to pay this month's mortgage payment. We're going to add it to your total principal balance, but you don't have to pay us now. We're just adding it. And you know, when you get back on your feet in 6 months or whatever, we'll revisit it and then you'll pay it. Well, that's going to be one big shock for a lot of homeowners, because it didn't forgive the debt. It just said we're adding it to your outstanding principal balance. So that's another issue that's going to come up. And the reason I don't think it's going to be a main issue is because these people should not be in that property to begin with. So
What do you mean? The homeowners should never have been in the property? Is that what you're saying?
no, some homeowners, not all
Okay.
homeowners,
All right.
some homeowners, because again, coming along now, so we stopped subprime lending. All, without exception, the subprime lenders went out of business because, again, it's the tail wagging the dog. If I originate a loan and can't sell it after the closing, I'm not in a position to service the loan. I don't want to keep a loan portfolio. And what happens is when you sell your loan in the secondary market, you're getting fresh money to originate another loan. And that's what keeps the marketplace going. Well, so what's going to happen to the people who have not able to pay their mortgage? There are a couple of opportunities. You can renegotiate the terms of the loan, meaning that it's a 30-year loan. You could make it a 35-year loan, lower the monthly payments. The other thing is you can convert your loan to a different type of loan instrument, meaning you can go from a fixed rate to an adjustable. An adjustable will give you a lower interest rate now, lower your monthly payments, and increase in the future. By an adjustable, I don't mean it adjusts every month. I mean it could adjust every 3 years, could adjust every 5 years, 7 years. There's 10-year adjustables. So there are other things that you could do, but the ultimate will be the actual act of foreclosure. But understand what foreclosure truly represents. These loans that people have, they were not most of them. Some FHA loans were like 3.5% down type of loans, but most of these loans required a certain amount of down payment. If you put less than 20% down, you were obligated to get PMI, private mortgage insurance. And what that means is that there are insurance companies who insured the first 20% of equity. So those insurance companies will take a little bit of a hit if those properties go into foreclosure. But the other side to that coin is, what truly does foreclosure represent? Foreclosure doesn't mean the lender takes back the property. Foreclosure means that the lender forces the owner of the property to sell the property. So what happens is if you can't sell it on your own, then foreclosure means the lender perfects their summary judgment and takes that and forces the sale of your property on the courthouse steps. Now it's a little more sophisticated in the courthouse internet or websites or what have you. Sometimes it's not literally at the courthouse. And what's happening is that, let's say someone bought a $300,000 home, was able to make the monthly payments, qualified, and now fast forward 12 months later, they can't make the loan payments and they don't do anything. And that's one of the problems that people have, is they sit and figure things are going to take care of themselves when in fact they will not. You must be proactive with your lender and servicer. And a lot of people don't understand that the lender, like when you went to Bank of America, got your mortgage financing, they don't have your loan any longer, chances are. So when you get your monthly statement, you'll see who has your loan. It's a servicing company, what have you. Those are the ones you need to communicate with. But communication is the key to resolve all these issues, either to restructure the loan. And if it's forced into foreclosure, remember, when they bought that property, they put a certain amount of money down.
Okay.
Chances are, if a house is put into foreclosure, chances are the owner of the house, even if they're in foreclosure, can walk away with cash. Because if I owe the bank $300,000 and I bought the property that's worth, at the time that was worth $400,000, and I can't make the mortgage payment, well, the lender is going to get the first $300,000 from the sale, and that's it. The other monies go to the homeowner. So it's conceivable it's not going to be as horrific as you might think.